from McKinsey and MineLens. Just joined McKinsey MineLens after a long career at Bloomberg, so I was quite used to seeing a lot of the data that we were seeing in the prior presentation. And what I wanted to talk a little bit about today, and thank you Minds and Money for inviting me yet again to one of your conferences. It's always a good time. What I really want to talk about today is whatever on everyone's mind. It's the #1 question I get asked is cryptocurrencies. And then the hypothesis is, what's really important here from a high level? And what I'll argue is it's blockchain. And how does gold sort of figure into things? And I'll give you I was a hedge fund manager for a long time, and I'll give you an idea of how the market is looking at gold equities and how you can figure out where the market really is in gold equities. First off, what the heck is blockchain? And blockchain is the innovation that is the important fact of what's going on in the world today. Think of blockchain as your phone, and your iPhone is your blockchain. And on your phone today, there is one app. In the future, there will be many, many, many apps, but there's only one app, and that app is cryptocurrencies. So what is blockchain, and why is that so important? If I go to a bank here in London and I take out money, I'll go to the bank, I'll put in my card, I'll get out my British pounds, it will go to the local bank, it will then go through a whole series of banks around the world, and finally, it will get to my bank in the United States where it will be reconverted into US dollars and debited from my account. It's a long, stretch of information that any place along the line could be infiltrated and be hacked, as we've seen many times happen. Blockchain is different. The blockchain would be, I go to the bank, and every single one of you in this audience, who are all my financial counterparties, instantaneously get a card that says, Ken put 1 point whatever cryptocurrency to so-and-so, and you all see it. And if along the chain someone says, no, I didn't actually give them that cryptocurrencies, every single one of you can hold up the card and say, wait a minute, I have verification 100 times over that you did this transaction. So what's interesting about blockchain and why is it so compelling is it's something that can go through different parts of the puzzle, and we can all sort of see it. So it's decentralized. It's democratization of data. So imagine if I'm out there and I'm a mining company and I'm looking at grades. Instantaneously, as the mine process goes on, everyone up and down the chain, from the mining company management to the auditor to the buyer of the material, can see every single point along that chain. And it's a way for everyone to be accountable. So what blockchain has done that's different is it just makes everything decentralized. It's not one point that can be attacked. It's incorruptible. If every single person in the room has transparency on every single transaction, then that sort of makes sense. It's irreversible. So if everybody in this room has this transaction, how can I go into every single one of your computers and change that number? So if one transaction is one card that each one of you has, and yet there's thousands of transactions going on, how do I sort of not overwhelm your inbox with all these transactions? What I'll do is I'll take every 10 minutes all the transactions that have occurred and put them together, and I call that a block. And then I send that one block to you every 10 minutes rather than every quarter of a second. And then in the next 10 minutes, I put together another block, and it's a block chain. And for someone, again, to go in there and try to change that, they'd have to go through all those different blocks and make all the different changes on every single one of your computers and try to make this different. And that's really interesting. The good thing is, this could really revolutionize the way we look at data around the world. Think about it this way. If my auditor has the same information instantaneously that my mine manager and that I have, I can close my books the second my quarter ends, because he already has the information. There's nothing to reconcile. It's already there. We already have it. It's done. That's why banks and financial institutions are so interested in the blockchain, because it takes all the back office out of it. If everybody knows all the transactions instantaneously, there's nothing to account for. It's always there all the time. The other side of it is the regulators. How does a regulator stop something in the blockchain when everyone has it instantaneously? How can they sort of correct? And I think that's part of the problem at the end of the day. Now, cryptocurrency is sort of an enclosed environment, and so it's a nice test kitchen for blockchain in that if we're looking in the real world, it matters on the data that's coming in and how can the data coming in be corrupted. Whereas in blockchain, it's an algorithm that's very tight, and all the people that come in sort of understand this information can see it all. So cryptocurrencies was a really good first impression of blockchain. However, everybody's working on the second and third iterations. Now, cryptocurrencies. Why, I think last night Bitcoin hit 9,700. I think at the end of the day, if you look from a very high level, it's not that cryptocurrencies are interesting. I think at the end of the day, what's interesting is it's showing that there's a symptom wrong with the the monetary system of the world. People are looking for something out there. Would it be Bitcoin? I don't quite know. But if you do look at this, Bitcoin prices versus everything else, is this a bubble? I'll let you decide. And so, when you look at cryptocurrencies and their numbers, and then I have this second chart here, and this is actually from some data from Bloomberg. You saw a 30% drop a couple weeks ago in the price of Bitcoin. It's since doubled there. That's not a currency. That's a casino. Imagine the real life use. I'm out there and I've paid 2 Bitcoins to buy raw material, and then all of a sudden overnight it's worth a half a Bitcoin because the price has tripled. It just doesn't work. So I think the technology behind cryptocurrencies is what's very, very interesting. How is that actually going to work in the real world is something I think that's going to be interesting. And that's where I think gold becomes the linchpin of taking the world's oldest commodity and oldest currency and putting it together in the modern world. Because at the end of the day, what you would want, what makes sense, is I'm around the world, I'm in Zimbabwe. That currency obviously doesn't function. And everyone doesn't have bank accounts, but pretty much everyone has one of these. How can I transact using one of these, but have currency, confidence behind it that tomorrow this currency isn't worth 30% less or 50% more or any types of volatility? What's behind that? And that's why I think you've seen the Royal Mint come out with a gold-backed currency that I think is going to be launched anytime soon. And what I think is going to be something that is going to eventually replace, look, we had the dot-com bubble, and then all of a sudden we had a big fallback, but in the ashes came Google and Amazon and all those other companies that we have today. It almost seems very similar today that we're testing out this brand new technology, and it's very fascinating and it loves to make a lot of news, but at the end of the day, I think it's the technology behind it more than the actual cryptocurrency itself that makes interesting. And why do I say it's a monetary issue? Let's look at the gold market. And I look at the gold market differently than I think some. I don't care about the US dollar. In fact, most of the rest of the world hates the US dollar. And the whole problem behind the US dollar is that it's a hammer over the rest of the world that the United States has. And a lot of people have been finding for a long time, how can they get themselves away from the US dollar? And the one country in particular that has a problem with the US dollar is China, who is also the world's largest gold importer. When the financial crisis occurred in 2008, China actually did what Ben Bernanke said they should do, which is put up helicopters and just drop currency like crazy into the economy to get it going again. In 2006, China had about 60% of the currency of the United States, which if I'm an economics 101 for the size of the economy, makes sense. Today, China has double the amount of currency of the United States, even though its economy is still quite a bit smaller than that of the United States. They've printed way too much currency. And they're also the ones out there in the world buying the most real estate and by far the most gold. How China reconciles its overprinting of money with its financial system, I think is one of the #1 issues that President Xi faces, and I think he completely understands this issue. And this is the problem that we're going to see. Look at this. And since 2006, you've seen almost a 500% increase in Chinese M2. About a doubling of the United States M2. And the amount of gold out there is up around 21% in terms of above ground stocks. So gold by its very nature is constantly appreciating versus paper currencies. But I also think at the end of the day, that stability that gold gives And that inelasticity of supply is what really causes gold to have something that the people around the world have always gone to, and I think always will go to. It's going to be the interesting entrepreneur, and I'm not sure it's been done yet, who does take that blockchain cryptocurrency and put it together with gold. And maybe it's not an entrepreneur, maybe it's a government. Maybe it's China who says, hey, we need to have gold-backed yuan, and we need to do it in an international way that everyone could use. One of the ways to soak up a lot of this currency would be to price their yuan in gold and suck that yuan out of the economy. So I think that's just something that's very interesting and something to look at. The speaker prior to me was rather bullish on gold. I think you can make a rather bullish case for gold. This is a gold summit, I just will talk it up. But at the same time, what we've seen is the gold industry itself is in really, really bad shape. I'm not sure if you saw Mark Bristow's comments the other day from Randgold sort of going against the gold industry, but the gold industry has real issues right now. If we look at what McKinsey believes gold production will be over the next 5 years, it's going to be flat and then it actually declines. You should see almost no new gold production coming onto the world market at best. And at worst, one of the things we've seen, not only in the gold industry, we've seen this across the mining industry, is the industry is obviously high-grading mines. This is actually showing each individual mine, and were they producing at a grade above the mine's specified rate in terms of grade or below. And the issue has been this industry, when the price started to fall from 1,800 to 1,000, started high-grading their mines. So much so that if we take together, and this is MineSpan's product looking at over 100 mines of the biggest mines in the world, you've actually seen the grades of ore rise by about 5%. You saw the price of oil drop during this time frame by about 50%, and the cost came down. So the industry's up here claiming victory. Wow, we're really fantastic. We've lowered our costs. We look really great. At the end of the day, you can really claim it's been some smoke and mirrors. They've gone out there, they've cut all their costs to the bones, they've high-graded their mines, the cash flows have come in huge. And the interesting thing is, and I was at the Denver Gold Show giving a presentation, if you sat in those presentations, you would still think gold was about $600 or $700 an ounce. Everyone talked about reducing debt. No one talked about new production. No one talked about exploration successes. By and large, this industry still thinks it's the end of the world. And as we saw from the last speaker, the cash flows show differently. All they're using all that cash flow for right now is to reduce debt. In fact, a number of the speakers talked about the only way to run a mining company is with zero debt. And that is just something that will destroy the industry at the end of the time, because there is no money going back into the industry. Our long-term view is we do see grades declining. In fact, we take every single mine in the world. We do something pretty interesting at MineSpans. We don't care what the companies say their costs are. What we do is we say, your mine is in this location, therefore your labor rate should be this, your diesel cost delivered to that point should be this, here's what your electricity cost should be, here's your exact process route, and that process route takes so much reagents, etc. And we build every single mine in the world from the bottom up, and then we say, this is what your cost should be. From that standpoint, we can cover every single mine in the world. As long as we know your process route and your ore grades and your throughput, we should be able to build every single mine in the world. And it's far more accurate than any other way to do things. And it's a way to use big data in a different and new form. From that, we can build up every mine, and from that, we can actually see that grades will decline over the next decade. And from there, we would see that cost will rise. And why does that matter so much there's a lot of investors in this room? Relative outperformance is what we all care about at the end of the day. We may want to buy a gold stock, but then the question comes, which gold stock? And history shows the companies that are able to reduce cost are the ones that are able to win in the relative performance game. It's a pretty simple equation at the end of the day. Investors every day are looking at gold stocks and they're looking at a net asset valuation, an NAV. NAV is very, very simple. It's your revenue, it's your cost, and it's how long those revenue streams will come together. That's the whole 9 yards. Now revenue, since this industry seems to believe that hedging is evil, everyone is getting pretty much the spot rate for gold. The costs are what can change. And so whenever you've seen companies reduce costs, that forces analysts to reevaluate their cost flows, increase the cash flows between that, and that's about 57% of your R squared, or your expected valuation change. The other 17%, which is the second largest and by far the biggest amount of your gain, is your reserves. So that's your tail. How long will you be producing? So those two factors will really tell you your relative performance, and what this just tells you is what we know. Those who were able in the bottom quartile or the top quartile in terms of reduction of cost did the best, and those companies that were unable to reduce costs or actually saw cost increase did by far the worst. And so that's how, when you ask managements what they're doing, just make sure they don't have to be high cost or low cost. Their costs just have to be improving to show investors that the cash flows will be greater than expectations. This actually is the MineSpan's product. We show a number of mines, where they look today and where they may look in 2026, just sort of a sampling of those mines, but you can see the cost rise pretty dramatically over time. And at the same time, we've seen an industry that if you strip down the raw productivity of the mines, and there's a big debate within McKinsey if this is even very aggressive. We actually think there's a number of the partners who actually believe that productivity has continued to slip. But productivity in this industry has been horrible. For all the technology, for all the innovation, and for everything else that's been pumped into this industry, to move the same amount of dirt, the same amount of space, costs a lot more today than it did 15 years ago. You can debate whether the industry grew too fast in the big boom and therefore training wasn't there, or they bought too much equipment, or however it sort of worked out. There's a bunch of different fundamentals, reasons behind it. But this industry does a far worse job of moving dirt around today than it did a while ago. That's something that they have to worry about. Last thing I wanted to talk about is, how do I actually put this into action? And I know we talked before about stocks were cheap, but there's a way you can actually tell that stocks are cheap in terms of what transactions are actually transpiring in the industry today. And this actually shows transactions in 2017 and the average price paid, and you've seen from the peak to the trough there's about a 90% decline in how much am I paying for an ounce in the ground. Look at two of the middle investors, they're investor groups. Some of the main buyers of mining assets today are not companies. Remember, companies are all out there trying to reduce debt. The seniors are still trying to unload themselves of higher cost properties in order to reduce debt. The majors aren't really doing anything right now. You've seen some juniors do some acquisitions out there, not many, but investors are out there, and they're really becoming important as source of capital when you want to sell a mine today. And how do I sort of figure that out? I put together sort of a piece, and this is using the new gold. We just launched gold a couple weeks ago, but this is what it actually does, is you need to create a net asset valuation. I've sanitized this. This was an actual mine out there that a deal was done upon. You're going to go through and look at what's the utilities, what's the electricity, what's the diesel cost, et cetera, to try to build up that NAV. You're going to build that through the mine life. I've just taken snippets of this. You can read some of it. I think the model's like 600 lines. And from that, you're going to come up with a net asset valuation. And then what you do is you play around with the numbers. What's really cool about this is I can go in and I can sort of switch numbers in, and I can tell, what did the market actually think about this deal? How was this deal priced, and how is it telling me about the market? And this is an interesting part. This deal that I took was actually done for $136 an ounce in the ground. I then said, well, wait a minute, what if I'm a private, an investor group, and I wanted to hedge out those ounces. I could go and I could get my Bloomberg out, and I can call up my local broker, Barclays, Goldman, whoever, and say, I want to hedge out these ounces through the next 5, 6, 7 years. If I did that and put those numbers into my model, I would have actually paid, a 60% discount to the NAV on what I can actually physically lock in today. And we at McKinsey are actually very bullish on oil prices. We have a $70 long-term oil price deck. So if I then went back in and said, well, I want to also hedge out my energy, which is below the McKinsey forecast at the current, that's a 65% discount. So the market is telling you, I'm going to sell these assets at today. What I could hedge out with that company who sold it could have hedged out and valued it at $218 to $224 an ounce. I'm selling it for $138, $136. The market is not valuing these assets at all at this price. The market does not believe these prices. The mining companies are telling you, we just don't believe the current market forecast. Not saying they're right or they're wrong, but they do not believe it through the prices they're actually paying in the ground today. So that's a very interesting part. Now, how is that going to translate? History says you're going to see more and more private equity guys walk into the door and say, wait a minute, I'm not getting any returns on anything. I can sort of lock in fantastic returns. The company who buys this asset and hedges out, and we have seen a very small increase in hedging, and I think some people have called it stealth hedging because they don't see the majors hedging, but they do see the hedge books increasing. That most likely is smaller deals being done by private equity firms who are hedging out. Because at the end of the day, if I'm private equity, I don't have to go through the whole thing that, I'm a gold company, people invest me for the upside potential. I don't care about cash flows. Well, a private equity firm, all they care about is cash flows. They don't care about the upside. If I can lock in 30% annualized returns, done, next deal, here we go on. And so I think you are starting to see private equity come into this market and starting to look at the hedging possibilities and realizing how inexpensive these properties are if I were to hedge out the future. Now look, people who've known the mining industry know there's a lot of risk in this. Mines are not as simple to operate as, say, energy. And so, energy companies have been doing this for a really long time, but they tend to be the flows out of a oil rig or a gas well are much more definable than the issues you all of a sudden find in when you're mining. However, at the end of the day, if the opportunity, the upside is so great, this is something that I think is going to happen. So as investors, please look at the NAVs, tool around, and try to figure out how the numbers really do work at the end of the day. And then you can sort of figure out from there what the market is sort of thinking and what deals are actually being done for, and that can help you make a good decision. When you were looking at, 2011, 2012, if you ran those numbers at that point when you were charging about $800 an ounce in the ground, obviously it was euphoric, and there was no way you could use the forward curve to make any sort of money. However, that has completely flipped on its head today, and as I said, it's about the cheapest you've ever seen these deals being done in the recent history. So it's just something that should be really interesting to look at. I do have about 2 minutes left, and I always like to take questions because I have to leave this afternoon. Question?
Are these private equity groups, are these American?
Question was private equity, are they American? In terms of who's been buying, I think it's been quite global. I think it's been Western, but you've seen some deals out of Australia, you've seen some deals out of Russia. I think you've seen a number of different deals. I don't think it's, capital is pretty nationalist blind. If there's money to be made, that money will find it. And it seems as if, I think the big question is, where's the expertise? I think private equity in general lacks the expertise of mining. So that's probably held back a number of deals from them being even more aggressive. There's not a lot of good mining talent out there to really assess these mines and actually run them. I think that's probably your single biggest issue. Any other questions?
Okay.
Yeah.
How do you deal with the risk and uncertainty of gold in the ground?
Yeah, the question, how do you deal with risk of gold in the ground and how do you model that? I think it's more importantly. The way we do is we have a slew of mining PhDs who have all done this in the past, and so they're very good at looking at these models and trying to do the analysis and look at the process trains and look at the history, et cetera. But you have to put in there the reason why it's good to have models that are that you can change a lot of the parameters in terms of the recovery rates, et cetera, is everyone's going to have their different long-term assumptions of what those are going to be. Yeah, I've been in quite a few rooms where we have all our team sort of talking about the grades and the risk and, will this extension continue? Will they be able to add, et cetera? It's always a good debate, so I'd always curtail it to be rather conservative, keep that inferred and stuff off of, or very, very low. And, the more drill holes you have, the better, and can give you more confidence in it. So you really buyer beware, make sure you have that information and make sure you understand the geology. Because I have had too many geologists say, this is the greatest play that's ever been, and it's all to come to naught. So that's where I sort of step away and I let our PhDs sort of handle that type of stuff. So they're pretty good about that. Last question, is there one in the corner? Yeah.
Do you think new technology in terms of
automation will improve the productivity? Because
Automation, improving technology, yeah. The funny thing I found out about coming to McKinsey is that's pretty much everything McKinsey does is about operational improvement, so I'm learning a lot myself. There's about 800 partners and practice people who all they do is that innovation. Yes, I think it will improve it, but it has to be done right. So one of the coolest thing I found was, so say you come to McKinsey and you want to get some improvement in your mind, they outsource the programming, most of it. But what they keep insourcing is gamers. And I said, why do you have gamers? And they said, well, the data coming in is the most important to run the mine. So if you can get the guys at the mine site engaged and make it into a game, they're much more accurate to put in real data and much more accurate data. And so they actually have physical gamers to make the mining process a game. And how do I beat that guy, and how do I get better, and everything else. In the process, you're getting much better data. Because I think the biggest problem and the biggest risk you have with automation and big data and everything else at the end of the day is you're generating all this data, number one, it doesn't do anything for you. Yeah, I'm getting 50 terabits of data. What are you using it for? How's it reducing your cost? I don't know, but look at all this data. So I think, how do you bring in that data? Is it accurate data, and how do you use it at the bottom line? Yeah, in theory it should all work, but at the end of the day, it better be good data. And number two, you better be able to use it to actually go out there. And I think that's the holy grail, is how can you actually get data from the drill site and work it all the way through your process? And that's where blockchain is going to be really interesting, because if you're constantly telling, at the drill bit, you're getting those grades, et cetera, and you can tell the processing plant that the material that's going to come through in 2 weeks is going to be of this, and you can start adjusting in advance, you can make that much more efficient than it was in the past. But if you're getting bad data, you're just going to be spinning your wheels and really screwing up. And I think, for the most part, companies are trying to figure out that right part. So in theory, yes. In practice, I don't think we've seen it just yet. And I think I'm out of time. Thank you again.